not the money. Not the money. The money is a derivative of doing the right things. In the beginning, you need to focus on doing the right things. The logic needs to be there, not the reaction emotionally and psychologically to fake demo money. Don't do that. You're actually causing yourself barriers. It really is creating a barrier for you to find success if you do those things. It feels cool. It feels fun. Like, yeah, if I would have been a real trade, I could have made this much money. But you didn't. So let that be the reality. You didn't. So you're really tricking and conditioning yourself improperly, which is the opposite of what I teach my students with backtesting. Whereas I teach my students when they do their backtesting, in their annotations, they write in there as if they saw the trade happening beforehand. And by doing that, it's like self-talk. You're speaking to your subconscious, and your subconscious is going to refer back to that as a false memory. Because it's a positive reinforcement, it teaches you because of pattern recognition and over again being exposed to the same elements, and you're reinforcing yourself with your own comments and your own cheerleading. You're fortifying your expectations going forward on this pattern yielding something in the past. Not that it's going to absolutely work in the future all the time, but we as price action traders, we look for signatures that repeat. Nothing is guaranteed that it's going to repeat. That's why we have that stop loss. That way we know that there's risk in this market. Every market in trading has risk. But if you're going to hone an edge or a model, you need to have a framework. And you start by backtesting. That backtesting, in your annotations, you talk about how it feels good to see this move deliver as I was expecting from this fair value gap up to this buy side liquidity pool during the hours of this, and this is what my model suggests I should be looking for each day. Notice I didn't say, I was stupid, I was playing video games, and I was watching some YouTuber talking about some nonsense, and I missed the trade setup. I should have known better. Never do that kind of stuff. Not in your backtesting, not in anything that you're recording in your journal. Everything has to be positive. You're sugarcoating everything in your backtesting. You're tricking your brain to see that as experience. So that way when you see it forming live, you're not going to be in fear and trepidation of, oh, it's going to be a painful experience anymore. Again, when right now, you don't have that experience yet, but because you keep logging it with back testing, you're filling your brain up with a lot of pseudo memories. So you're doing the ideal utilization of a lie. You're lying to yourself. And trolls will love this. You're lying to yourself with positive reinforcement. Okay? So that way when you look at something forming real time, it will be remembered, and you won't have any negative triggering because of toxic annotations or toxic thinking. You'll have memories of, oh yeah, I remember seeing that, and your subconscious, you may not see it or understand it or feel it when you're doing it, but your subconscious reverts back to those experiences that you've logged with positive reinforcement. Don't take a demo account and do that same thing with, I'm going to over leverage my demo account and do a size of leveraging that there's no way I would be able to, number one, put the trade on because I would be too scared because I'm a new trader and I'm going to be afraid of any fluctuation. And if I put on $1 million worth of leverage, I can't really sit through the spread opening up on me when I put the trade on initially, let alone weather the ups and downs as the trade pans out. You're teaching yourself to anticipate a hopeful outcome with ridiculous leverage. And you're teaching yourself that negative drawdown that you're experiencing is not something to be worried about, because you're only looking for the dopamine hit if you did it right. And that video game high score means absolutely nothing in your growth. You've created a speed bump and sometimes a barrier to being consistently profitable. Think. When you do those things, what you're saying is, I'm putting blinders on. I don't really see the real risk here because it's paper money. And I want to show on my video a really high profitability in the end result because you want clout. It's all about clout. You don't want clout. You want consistently profitable. Trust me, because of adding these little things, these flavor enhancers to your experience and calling them something that they're not, because they're not going to make you better. They're going to actually hurt you by over leveraging just because you want to see big numbers show up in your trade. Everybody watching knows that you've got a demo trade. They know. So don't parade around with it like it's a big deal. It's not. So the way you make it more respectful to your viewers and also remove the element of clout chasing. Use the smallest leverage. Let the people that want to heckle, let them heckle. You worry about being consistent.
Michael, welcome to Faith. I'm going to make you the presenter now. And looking forward to hearing your voice and seeing your screen.
You as well, sir.
Thanks so much for joining us today. Your reputation precedes you in here. You know, I also like to bring on a lot of people that aren't well known to lift them up, give them visibility, because I'm a believer that it's not always the famous that are the best.
Right.
And sometimes it's the people that no one knows of that are great traders. Sometimes the famous are just great marketing people like me. So great to meet you and have you here. You're a mentor of mentors, because I've interviewed one of your mentees, Saeed, and he gives you credit for teaching him, and the response on Twitter was pretty big, so you have quite a following. So I'd like to start before you had a following, when you were just looking into the markets and how that happened for you. Did you have mentors? So why don't you jump in a time machine, buddy, and tell us about the beginning of your journey into trading.
I started in 1992. November 5th of this year will be 26 years for me as a follower of the markets. I had an uncle that was worrying about the money and just keeping a low end, objective. All I was trying to do was make $1,000 a month and retire by 40. And over time, that became realistic. It became easy. And for months, I could have been doing a lot better than I was initially. And then I started understanding money management and applying more. And then it just grew from there. But I would say it wasn't until about 6 years after even being profitable, 6 years until I knew exactly what I wanted to do to be consistent. Because I would always chase something new. If Larry Williams put out a new book or a new, indicator or a technique or something, I was buying it hook, line, and sinker. I'm not trying to disparage anyone from doing those types of things, because it helped me become the trader I am. But, there's a lot of things that we go through as a developing trader and we ingest as far as supposed knowledge or insights, and it really isn't helpful at all. It feels like it is because we're doing something, and that's what we want to do as traders. We always want to be involved in the marketplace. We want to be engaging somehow. Otherwise, we feel like we're wasting opportunities. And when I found the setups that I like, it became crystal clear to me what I want to be doing. And if I didn't see them in the chart or the probabilities for them to form, I really wasn't pressed to get into the marketplace at all. And it created a different mindset, a paradigm shift from that of that's taught by books. That, they teach you to be an action hound. Take your setup, push your edge. Those things didn't work for me when I took a more relaxed approach.
You found out less is more?
Absolutely, and that's what I preach. It's not the quantity, it's the quality of the things that you're looking for.
Can I make one comment? You know, not many people bring up that, you know, they went through some type of conversion experience through trading and being broken in that way. But you ever see that painting of a shepherd that's carrying a lamb over its shoulder?
Yes.
Okay. In the old days, the shepherds, when they had a stray lamb, what they would do is break one of their legs and carry it around that lamb until it healed. And then the lamb or the sheep learned to always depend on the shepherd. And so sometimes that's what God does to us. You know, he breaks our leg. So, you know, I think that I appreciate your openness on that. So why don't we get to what most people are interested in, and that's money. And tell me what you see happening here in the Dixie. What I see, you have no indicators, some squares, some lines. So you trade pretty naked. I hope you keep the shades drawn.
Yeah, I do incorporate some things on my chart, but it's not like an indicator like you would see from a platform or anything like that. I do make notations with like rectangles just to draw out an order block, or I draw a reference to a specific equal high or equal low where there would be a stop. But as far as the dollar index, you know, I'm looking at the equal lows that we had in here. We just pierced through.
Yeah.
The obvious next level of liquidity is going to be above these highs in here. And then we have this inefficiency right here. Okay, and right above that, we have that old high, old low back here. So from a traditional support resistance standpoint, I think there's a lot of value for that to come back and play. So around 90, 80 to 91 big figure. It would be interesting to see it come back, at least at the minimum, go back above this high here. Because if this continues going lower, and honestly, I think the dollar is going lower. I see 87, 85 in the cards if we can reject once we get back above these highs in here. I mean, we got a pretty good mature downtrend going on in the dollar now. So it's not unreasonable for it to come back up in a deeper retracement, knockout trailed stop losses for anyone that would be bearish on the dollar now, pick up some more liquidity, and then make another leg lower. That's
what would change your mind that we're not going up there, and perhaps we don't take out 90.50? What would be the first indication or trigger that scenario is not playing out and we're going to new lows, perhaps your 87 level you were talking about earlier, not later, but maybe from here? What would tell you that?
To make sure I understand your question, what would negate this idea I have in mind here? Is that what you're asking?
Yeah.
Okay. If we failed to stay above, what's today? Tuesday. If we stay above Monday's high, as long as we're staying above that, I think that's what's going to happen. If we lose Monday's high, then we're probably going to just roll over. But to me, this is too deep of a retracement to just stop here.
I hear you. Okay, so great look. And you're a longer-term bear. Is this the main instrument that you trade, or are you a portfolio trader? Do you have several positions on at the same time? What would you say is the max amount of positions that you have on, or different instruments that you have on at any one time?
Well, I'm primarily a fiber or cable trader. I use the dollar as like a barometer. It tells me what I think I should be doing from a macro standpoint. But
why did you select cable? Why did you select cable as your main instrument for trading?
I traded a lot as a futures trader. I transitioned from futures to solely FX in 2006. So I haven't really done any other asset class since 2006.
Okay. And so what's your take on the pound? Let's go to your bailiwick and talk about it. Lately it's been underperforming the euro. So I'm curious as to what your take is here. Now, to me, it looks somewhat positive. Are you in the same camp?
Longer term, I believe we're going to take out the high here.
Okay.
My concern is do we need to come all the way back through and clear up this inefficiency? I don't want to see it do that. It certainly is kind of like all this price action is really just standing on top of this one candle. Now,
call it inefficiency. They're large, directional, impulsive candles. What's inefficient about that candle?
Okay, from a standpoint, I'll give you a contrast. What we learn as retail traders from textbooks, teachers, gurus, and educators, price moves because of an indicator. Indicates that price should go higher or lower based on overbought or oversold, and that's not true. What the market does is it seeks liquidity, and when the market's being driven, there's engines that produce the market's movement higher or lower. And once these engines start delivering price higher as a market rallies like this, price will skip. Not every single one of these price levels will be offered. So kind of like as a futures trader, and you can appreciate this because it's a gap.
Okay, like air pockets way up.
Exactly. I like to use the analogy of a paint roller. Okay, imagine if you had a paint roller and you applied paint to the wall, and you start the roller to the wall here and you start rolling it up. In the first couple inches, it's going to be a real rich layer of paint. But as you keep going higher, it's going to start getting pockets where the paint really wasn't delivered that well, and you got to go back down to it and fill it in. That same thing happens in price action. So if we look at price action, and this is something your listeners can do as an exercise, it doesn't matter what time frame you do this in, but if you look at every single time where a up candle, the longer the up candle, better. Okay, you don't want to do it with like little short stubby candles, but the candle, if it's long, take your chart, print it out, and take white out, or kind of like block it out, and watch over time how price will go back in and fill that in. Now, as a futures trader, we have the gravity of closing.
Right.
When prices would close and the next day's opening, there would be a difference between that, unless you looked at the Globex market.
Well, yeah, we knew how to trade gaps. They just don't happen much in FX because of 24.
It's a 24-hour, right? But they still exist. They still exist, and the inefficiency is that price has not been offered on both sides, buy and selling here. It's been an imbalance of only buy side delivery offered. So price will inject volatility on the upside, but the sellers really didn't get a chance to do too much in here, and the buyers didn't really get a good chance to buy at all the levels that were offered in the open to the close. So if you look at every single time that the market will want to retrace, well, if you look at this here, this down candle here, we left this high here. Let me zoom in a little bit so you guys can see it. One more time. All right, so we have the market rally up, take out this old high here. I don't really concern myself with the wicks, so we have a slightly higher high here, and then we rejected that. This down close candle, just think of it as that paint analogy.
Okay.
It's been offered on the sell side, then the next candle opens, and then it goes up a little bit, and then drops down. So these two candles have only offered what? Buy or sell delivery. Only sell delivery.
Right.
So the imbalance is it's only been selling, but where's the imbalance really stopped? This candle right here, where its low is, the next candle here, that open. At that open to the high, that's when buy side delivery is offered. So the imbalance ends at this opening. And you can see the bodies of the candles stopping right there. See that? So the market retraces up to that price point perfectly at the precision. And then the algorithm will allow price to start dropping lower again. If you look at these inefficiencies, and there's a lot of things that go along with it, I'm just giving you one element, very simple approach to it, but it's even more radically precise than what I'm showing you here. And it's on every time frame. So the key is, and this is what I've done over the last 15 years, is look for opportunities where price will have these inefficiencies on a higher time frame, and it creates like a magnet effect. And if I can trade in that direction, I don't look at trend lines, I don't look at moving average crossovers, even though I've used them to teach the concept of momentum from on a higher time frame basis. I use imbalances and liquidity pools, which is stop runs, really to frame all of my trade setups. So either I'm trading inside of a range or I'm expecting the range to be broken from a directional standpoint. But it really is all hints.
That's great stuff, Michael. In fact, someone in our community, LaShawn Turner, is asking if you could show your ICT order block. And, if it's proprietary, I understand. But she said it's very fascinating, the ICT order block.
Okay. And that's pretty much what I'm known for. When I stepped out on the baby pips, that was like the first thing that everybody gravitated to because they could see something, and it wasn't relying on indicators. The problem is, at first glance, it looks like supply and demand, but I don't stop with just the most recent level. Like they'll teach like only use fresh levels and don't cut through candles. Well, if you don't cut through candles, you won't get the breaker. Okay, and I'm going to amplify what she's asked for, I'm sorry, if it was a male or female, I'm not sure who asked, but these up close candles. Okay, we're looking at a daily time frame. So if we had a way of forming a chart, creating one candle for every 3 days, this would be one singular up candle. Now this candle, or series of up candles, is all one order block. Now, what is an order block? An order block is where large institutions, banks, they will sell into that rally. Large institutions have rules. They cannot sell short on down-moving markets. They have to sell short as it goes higher, and they can only buy when it goes lower. That's the only way they're going to get their pricing, and because their sheer order size, it requires them to do that. So the order block theory is if we see price rallying up, and we're taking out old highs here, if it rejects, I don't need to know that it's going to stop here. I don't try to pick tops and I don't try to pick bottoms. I want the institutions to leave their telltale signs and hallmark signatures in price action. So while I have already shown you the inefficiency and the rebalance of this opening here, because the wick offered buy side, anything below that is, again, all sell side. Well, we see the balancing of those orders right here, and then look at the reaction we got there. Go further, cut through this candle here, okay, and you'll see these up close candles. What's happening here? Well, anything that was residing above these opens and closes on these candles here in the form of a protective stop, they're running them out. That creates this as a breaker. Now, I teach two styles of breaker. Breaker is basically breaking the market structure. Anyone that was short that had to stop above these bodies of these candles here, they have been neutralized. They're not in there now. So when the market goes down, exactly. So now my eye goes right to the bottom of this candle right here, the body, not the wick. I'm looking at the body of the candle here. When price trades back up to it with these candles here, right when we hit this here, we are in sell territory. I'm going to start looking for reasons to go short. Now, this is where everyone looks at my information and my free tutorials, and they just think every up close candle is a bearish order block, or every down close candle is a bullish order block. You have to apply some context, and I'll give you some more context and apply what I already showed you. This is the stage. This is a bearish order block. But inside this order block, there's going to be an inefficiency that you have to use to set up the signal. This is the opportunity, but it doesn't form until you get to this level right here, where we described where it was only going down. Well, when price starts trading up these up close candles, it goes right to the opening of that candle and stops right about that same level, goes a little bit with the wick, but then we have delivery on the downside. This element of price delivery is where institutions come in and they do their buying and selling. It's not based on indicators. It's not based on trend lines. It's not based on any of those things. That's all, red herrings to get you thinking. And once in a while, they do work like anything else. But that is what's sold to us as retail traders. We buy all these books, and I own over 2,000 books. I've read every single one of them, some of them twice, in hopes that I understand the markets better. And literally, I have a checklist of maybe 12 books out of all that I think is useful. And most of them aren't really indicator-based things. They're all the way you think about the market.
Okay, name a couple.
Well, Trading for a Living, not the stuff that's technical. Okay, Alexander Elder's book about the way he kind of like draws the contrast between an alcoholic and a loser's mindset. I gravitate to that. I've never drank a drop of alcohol in my life. I've never taken drugs, never done anything like that. But I grew up in that environment. And the way my family interpreted what I was doing in the markets, they said I was going to be a loser like them. Yeah, it's gambling. Yeah. It's a pipe dream. Right. Well, they're all asking me for money today. They're all working. I don't go to work. I'm talking to you today. So, and it sounds braggadocious or arrogant.
But fun, huh?
Yeah, but you have to discount those people.
You want to go back out and fill up a candy machine today, Michael?
No, I don't want to do that anymore.
All right.
I don't want to do that.
Got some fascinating stuff. Now I know why you have such a following, Michael. So you were published, your work's all over the place a little bit here, guys. And we'll wrap it up with the TGIF. I want to thank all the viewers from investing.com for joining us today. Good hunting the rest of the day. If you join Forex Analytics, you'll see the team in the private chat. And remember, most of all, don't just count your pips, count your blessings. And I'll see everyone to wrap up the week tomorrow. Thank you again, Michael Huddleston. It was a pleasure meeting you. Adios.
The mystery that plagues all speculators is what trading approach is the one that's going to make me money, and I don't have to worry about losing more money in flawed approaches of trading. What you're saying is there's a method out there that is better than everyone else. I'm humbly submitting to you, you have found it. It's not costing you anything, but it's going to require some work. It's going to require some time, effort. It's going to feel like you can't get it. It's going to feel like you're never going to understand it. That's all normal. It's all normal. But you'll get it. There's folks in my 2016 group that couldn't get it. They got it now. Took them a couple of years. Others, they get it real quick. I don't understand why some get it quicker than others. I just know that it's like that. And you might be one of those slower learners. It's okay. I was a slow learner. But once you learn it, it's yours. You don't forget it. It's like riding a bike. And that should be your passion and your pursuit, to get to know how to do this like riding a bike. You can put the bike down for a couple of years and then get back on it again, and just like you never stop riding it. And that's a comfort and a confidence that is something that I can't articulate into words. And if you are able to find consistency and profitability, it doesn't matter what you're doing in the economy then. It doesn't matter how much it's going to cost you for a gallon of gas or how much it's going to cost you in your groceries, because you can outpace inflation if you know what you're doing in these markets. That should be your goal. Always outpace inflation. And there should be no concern. I'm not promising you rich. Can you get wealthy with this? Sure you can. Am I promising it's going to happen for you? No way. Will you lose money in the process? Absolutely. I'm guaranteeing you're going to lose money. Every trading system, discipline, educator, everybody loses in trading. They take losses. Some take stunning losses. Others just take mediocre losses that are just nuisance. Other traders that are really, really good can have periods of drawdown and then regain that equity drawdown back. It is like it didn't even happen. Not even skip a beat. That's experience. These are all bridges that you're going to cross. You're going to cross them at times and intervals that I can't outline in advance for you, but I generally know the concerns and questions that you have at this point. My request to you is to suspend those feelings that you have to have all the answers right now, because you don't. You have to be more diligent about placing yourself in front of the charts and back testing, researching what I'm showing you, because it's there. And by seeing that over and over again, it's better than a book. It's better than a course. It's better than a mentorship that you pay, because I'm teaching you how to go into price, and price will teach you. It will teach you. It's repeating. So if it's repeating and you're looking at it constantly, you are training your eye to see what it does by default. I'm I'm teaching you how to go through price action and ferret out these repeating signatures. And it isn't just a handful of examples. It's every week, every day, and it won't stop. Nobody out there going to tell you that you're not. That's my audience right now. That's who I'm talking to. Because if you're on the fence and you expectations and entitlements ridiculous. It's funny, entertaining as shit, but it's unrealistic. It's crazy. But that's what trading's like sometimes. You could be ready to do it, and I'm not ready to do it. And you got to be okay with that. And no, guess what? that.